Hey guys, Nick Kellar, Greg Brock, another one of our video blogs. Today we are honored to be joined by Matt Nader with First Home Mortgage. And we're going to jump into another video blog today. Today we wanted to talk about the difference between the Fed funds rate, something that a lot of you probably hear that's going to be raised or rumored to be raised or has been raised, and the actual mortgage interest rate and how the two relate or not relate.
Sure.
So let's just jump right into it.
All right, let's do it. So Fed fund rates. Fed fund rates is the overnight discount rate from what banks are borrowing or lending money. It's not a direct, it is somewhat of a correlation with mortgage rates, but it's not a direct correlation with mortgages.
Okay.
What the Fed funds rate encompasses is auto loans, credit cards, home equity line of credits, which is a mortgage, right? Mm-hmm. So most home equity line of credits are tied to prime.
Sure.
Prime has increased from October of 2017 to this year. I mean, we're up almost 450 basis points, which is 4.5%.
Okay. Yeah. Okay.
So that in itself, yes, has affected mortgages only on a home equity line of credit.
Got it. So it doesn't have a direct correlation to mortgages to buy a house.
It does not have a direct correlation, no.
Okay.
The indicators as to why the overnight discount rate is going up is a correlation as to why our interest rates have risen over the last 16 months, we'll call it. And it's just, it's the economy. The economy on paper has improved,
healthy, right?
It's jobless claims are down, unemployment is down, wages are up, consumer confidence, consumer spending. It's all giving us factors, whether we feel it or not, it's all giving us factors that, yes, this economy is improving. So from that, our long-term, our 30-year fixed rates, our mortgage rates have increased. The best indicator to watch where rates are going is really the 10-year bond.
Treasury bond.
The Treasury bond. So if you're watching what the 10-year is doing, if you look back October of 2000, let's just say January of 2018, the 10-year was at about 2.1%.
Okay.
In October of last year, we got to 3.19%.
Okay.
Our mortgage rates were over 5%.
And that was the highest they've been in years.
A long time.
A long time.
Since then, we're back down to about 2.6.
So where are interest rates now?
We're about 4.5, 4.625.
So they've gone back down.
Correct.
And that was kind of a surprising move.
We all were forecasting an increase throughout the next couple of years.
So you had just mentioned a little bit ago prime. What does prime mean?
Prime is a word. It gives us what that interest rate is going to be.
Got it.
Okay. So what you're, in summary, the Fed fund rate is what it's not a direct correlation to how the mortgage interest rates are going to go one way or the other, but it's encompassing of how well the economy is doing. So it's more of the government's confidence in what the overall economy is doing.
That's correct. Right.
And the more direct tie to mortgage interest rates, as it would affect most consumers out there, is the 10-year Treasury yield.
That is correct. Yep.
Okay.
Yep.
Cool.
And the good thing is, I read a lot on bonds, which is weird, but I do.
Wow.
Forecasters are assuming and thinking that the 10-year could be back at like 2.25 come summer, which means we're in a 4.25% market again.
Wow.
Which would be awesome.
Wow.
Yeah.
So, surprisingly, mortgage interest rates have gone down, which I think surprised a lot of us in the industry.
Absolutely.
So opportunity is still out there. Hopefully this cleared up what you guys see as the Federal Reserve raising the Fed fund rate and how mortgage rates actually go. But if you have any questions, feel free to reach out to any one of us. As always, appreciate the support and checking out our video blog. We'll see you next time.
Thanks a lot.